We'll visit some economic data from last week first. Let's look at durable goods. Pretty good order. 16.4 on the headline, but one big airplane order can skew that. So let's look at what it is and take out transportation. Up 0.5, the month before was revised up to flat. If we take out defense spending and just aircraft so that we can leave the effect of automobiles in there, up 1.7. The previous reading was negative 1.4. If you had done a time series on this to try to predict the next month, an autoregressive time series B and time T, you would find that this is no different than zero, meaning that this is a random walk. And if you look at it from month to month, you get something that looks like this. You know, it's the most random series that you'll that you'll find. So even though we have a good number, next month could be something completely different. It could be in the same direction. It could be zero. It could be negative. It's just the nature of this series. GDP. This was our final look. We get an advance, a preliminary, and a final look as more data comes in. Negative 0.5 from negative 0.2. This is Q4. All of this here is Q4 of 2024. So you can see quarter over quarter the evolution. Corporate profits negative 3.3. This is the big one down here. Real consumer spending, because the consumer really drives the economy. Positive, up 0.5, but certainly down. Now you may say, yeah, but this whole has Christmas. These are all seasonally adjusted numbers, right? So it's adjusted for the fact that Christmas is in there. That's a big drop off. Going into Q2, it is the end of the quarter on Monday in one day. By the end of July, we'll have the first look at Q2 GDP. Atlanta Fed has it at 2.9% as of June 27th. There isn't much data coming in up to June 30th. I think the next adjustment is July 1st on this one. 2.9 down 0.5 from 3.4. You could see the green line here. This is the GDP Now estimate, how it's come down as the quarter has progressed. Let's skip over the trade balance. Let's go right to initial claims. 236 elevated, but 10,000 off. We had a couple of weeks running at mid 240s. 236 last week was 246. But continuing claims, this is where the problem lies. 1937 last week, expectation for 1950 came in at 1974. A couple of arguments for this that are popular out there is the level of uncertainty and AI. If there is uncertainty, the equity market, this is news to the equity market because the equity market has no uncertainty whatsoever. But, you know, companies' actions and investor actions can be two different things, and right now they are. If I were in the U.S., looking at significant investment, I'd be saying, look, I don't know what tariffs are going to be. I don't know if there's going to be reciprocal tariffs. I don't know what countermeasures other countries are going to put on things. I don't know what interest rates are going to be. I don't know what the investment climate is going to be. I don't know. And I would agree with that. I think we are at peak uncertainty. And again, don't tell the equity market that. In situations like that, you freeze. You just say, well, I'm just going to stand pat until I see my way clear, which means bringing new people on probably drops off. That might help explain the level of unemployment for new graduates. The other argument is AI. We really can't go a day without hearing a story somewhere about how AI is replacing this task, replacing these jobs. Companies are reporting that, you know, AI is now doing this or doing 30% of that. And if it's doing all of that, either you're going to massively increase your output, and so is everybody, which will lower prices, or you're going to decrease your workforce to maintain your output, but increase your margins. I believe both of them. I think uncertainty is taking its toll, and I think AI is taking its toll. In fact, if you have uncertainty, you have a lack of investment going on. One of the industries, one of the fields where unemployment, new graduate unemployment is very high, is in fact finance. It's an ugly market out there. And another high one, I think this is the highest one, is computer science. That seems odd. If you have an AI revolution going on, you'd think you'd need more and more and more of these people, but they have the highest unemployment rate right now, computer science, new graduates. So it's not a good time to be unemployed. And if you do have to do any kind of retraining, you have to really think hard about, well, what should I do? Because I need to be somewhere in the future where AI can't really affect me that much. And this stuff is evolving fast. The tools that show up every day, the new models that are showing up that can do video, that can do images, the new reasoning models that every week somebody has a new reasoning model somewhere. The evolution of the LLMs, this is the speed at which these things are hitting reminds me of 1999, where every day you had 2-3 new .com showing up. A .com for this, a .com for that, and VC money was just rushing into that space. This is what you have right now. Many of these new AI companies you go to, right on their landing page, just raised 8 million, just raised 7 million, 6.5 million. And they're rushing whatever specialized tool to market they can get. The big guys have the big foundational models. We'll spend some time with that later in the video. But these specialized models are appearing everywhere. And much like the .com era, there isn't enough space for all those models. Much of it has to go. I do see this whole thing going the same way again. We'll spend some time with that later in the video. Let's get to the goods trade balance. This is an advanced look for May. Something that I think did not get enough attention, but that I do see a canary in the coal mine here. April, negative 87 billion. May, we had a month with the full effect of all the tariffs in there. We went from 86.97 billion deficit to 96.59. Expectation was only for 88. It actually came in deeper. If we look at imports, that's not the culprit here. No change on imports. I shouldn't say it's not the culprit. It is a culprit. We would have expected a drop in imports if, in fact, the tariffs were meant to encourage more U.S. production as opposed to bringing it in, or switching to U.S.-based products as opposed, as substitutes as opposed to the import. We would have seen some effect here, but 275 to 275.9 to 0.8, 100 million. That was it. Now, it's only 1 month, but the evidence is consistent with a premise saying it didn't have much of an effect on imports. And I think that's a logical statement. The supply chain, especially with U.S. corporations, the supply chain that exists is highly efficient. It is not something that has haphazardly come together where somebody says, oh, I didn't know I could buy that just down the road here in the U.S. I've been buying it from Thailand. It is what it is because of its efficiency. If it was more efficient to make furniture, wooden furniture in the U.S., there'd be a factory making wooden furniture in the U.S., and that's where it would be ordered. You're looking at a supply chain with decades of incremental efficiency improvements upon it. It is hyper efficient. So when you throw a tariff in there, you're not going to affect that supply chain very much because the infrastructure is built around that efficiency. It's not built around a level of inefficiency. But now with the 10% on, perhaps in some future months we may see an effect, but you're certainly not, I think at 10%, not really going to see it. I think you'd have to push that to 30, 40, 50% before you really start seeing a change in that supply channel because, again, it is efficient. However, exports, 189 down to 179, that is, I think, consistent with the way that this administration has pursued their trade policy, which is in a very belligerent way. So you do have anti-U.S. sentiment. You do see it in Canada. You have tourism from Canada to the U.S. down some 40%. That takes billions out of the U.S. economy. Now, this is only for goods, but U.S. alcohol, right? So if it's not on the shelves, it can't be sold. And there are other countries as well, and other citizens in other countries that are saying, if we can avoid U.S. goods, let's avoid them. Now, I'm not saying that's a wholesale thing going on across the board, but at the margin, people who wouldn't have thought about it now do think about it. So I seem to think that if you stay at a 10% tariff, you're not going to change imports at all. However, because of the nature in which you're doing this, the administration's not looking for trade deals as much as it's looking for a shakedown. Threaten every country as much as you can, see what they're willing to give up, hang them by their heels, shake them, see what falls out of their pocket, and say, well, it's more than we had before. That type of behavior only pushes people away from doing business with you. So I think this will continue on. I think that U.S. exports probably will continue to lag. Imports probably unchanged, which means the goods trade balance, I think, will only get worse. And I think that as time goes on under this administration, you'll probably see some of the largest trade deficits printed. Last year was $1 trillion, 900 and some odd billion dollars. It wouldn't surprise me if during Trump's term you exceed that. You see 1.5, 1.6 trillion. I think this probably gets worse. Why this didn't get more attention? There's been no dent in the imports, but a certain dent in the exports. Why this didn't get more detail, I don't know. I do seem to think that, if you combine this with the uncertainty, I think you can work on an 18-month principle here. It is more than likely that this administration is going to lose the Congress, lose the House in 18 months in the midterms, and that new Congress will more than likely repatriate to itself tariff power and take it away from the executive. Congress right now is missing in action when it comes to these tariffs. You have a tariff king at this point. Once that happens, other countries will probably say, you know what, why would we make billion-dollar investments when in 18 months it's more than likely that you're going to lose most of this power anyways? So I don't see a lot happening. I see a lot of, and I'm using air quotes here, deals being announced that, there's this investment and that investment. If I wanted to avoid the administration's wrath, I would say, well, what does he want? He wants a public victory. Well, let's give him a public victory. Let's give him an announcement. We don't have to do anything. We just have to give him the announcement. We know that will take pressure off of us because we've given him what he wants. What's important to this administration is the announcement of a victory. Well, it's the announcement of anything that will be a victory, no matter what it is. They're not so much looking for good deals, they're just looking for deals that they can announce. So I'll give them that, but I'm going to work on the basis that in 18 months, Congress is going to take much of your power back. So I'm really not going to do much. So I don't see this improving at all. Now, if this doesn't improve and the trade deficit gets worse, what's going on with U.S. dollars? Well, there'll be more U.S. dollars put out there. To have more U.S. dollars put out there, what has to happen to U.S. assets? More U.S. assets have to be sold and owned by foreigners. So under Trump's term, paradoxically, Make America Great Again will be make foreigners own more of American assets. More interest being pulled out of the U.S. To foreigners, more dividends being pulled out of the U.S. to foreigners, more capital gains. I've been doing that for years. Thursday, Mexico, rate decision. Look at that, 50 basis points down, 8.5 down to 8%. And on Friday, we got PCE month over month. The headline 0.1, core 0.2. Annualized, these are benign. So I think it's more than enough permission to cut on July 30th. Okay, rates and yields, money market rates, all well behaved. 10 basis points coming out of the 1 year, starting to price in some rate cuts, 17 out of the 2 year. And rates down across the curve. The 20 and 30 were doing better At one point on Friday, TLT was over 88 before giving back a little bit, but TLT did squeak out a gain of 0.85. Nothing compared to S&P's another 3.44%, to places where all that really seems to matter now is the behavior of the crowd and the infectious behavior of the crowd, and less on the fundamentals, because it just doesn't seem to care about anything, right? And the dollar index down 1.44. Looking at July, 31 days, I think this is completely wrong. A cut, less than 20% probability of a cut, still over 80% that nothing is going to happen. You have had a couple of voting members coming out now saying, yeah, I can support a cut in July, but we still have a couple hurdles to get through. We do have a jobs report to get through, and we do have another CPI, and this is July 30th. I don't think we'll have the PCE, but we'll have the CPI from that. So you still have one jobs number, the CPI. You have July 9th, which is the counter tariffs, or the reciprocal tariffs day, but there's word that, well, that will be delayed another 90 days because there are no deals. And I think Trump has put himself in a very bad position, and I'll explain that a little bit later. But if I were negotiating against Trump, I know the one thing he wants, and I can hold off to the last minute. So that he has no deals to announce, because if he did, I guarantee you there'd be a lineup of people behind his desk in the White House, and there'd be a press conference announcing this deal that nobody thought could ever get done, and it's been the most wonderful deal ever. You know the script. So there's a belief that that will be extended, and if that gets extended, the uncertainty gets kicked down the road. I don't know what the Fed will do, saying, look, we have that sitting in front of us. Should we just hold? It would be nice if by July 9th he said, you know what, we've got everything done. There are no reciprocal tariffs. It's over. It'll just be the 10%. Then you'll get a cut. You're going to see the probability shift to this very, very quickly. But we do have jobs and CPI ahead of us. Nothing. The CPI is for the month of June. Nothing in the month of June tells me that CPI would be any higher. And given the relentless news flow of how difficult the job market is, there's nothing that tells me that this is going to be a strong jobs report. So I think by Thursday you can see a big shift in these probabilities. I think they're wrong. And when we get down here, Fed funds futures, we'll see that the market is also thinking the same thing in terms of pricing in more cuts. Slope of the curve, we are more inverted on the 3-month to the 10-year. 10 basis points, because the long end of the curve is coming down, and as it comes down, it's reinverting, because it is predicting that it's going to be necessary for the Fed to cut. July 1st, Canada's market is closed. That's Tuesday. July 4th, the U.S. is closed, so we're going to get a whole bunch of data on Thursday instead. Monday, you have two speakers. Tuesday, Powell at 8:30, and Thursday, you have Bostic. Look at the week. Tuesday, we have JOLTS data. I don't think that's going to be important. I think it's less and less important now. Wednesday, ADP. It still moves markets, so you got to pay attention. And you get in the challenger job cuts. Of the two, I think this is the more critical one to look at, the challenger job cuts. Thursday, initial claims, and you get the jobs report. ISM manufacturing for June. We get on Tuesday, and ISM services you get on Thursday. The balance of trade for May we get in 4 days. That is going to be a big number. At least in my thinking, I would be looking at that, because all of this nonsense we've been going through is about trade, is about reordering the global trading system such that you can get rid of that trade deficit in the U.S. Well, you have been working at it. Where is it? We have a clean month in May. We should see something, right? If we look at goods, not so much. So I think that should be an important number to look at, but it seems to just get second or third fiddle. I think this is going to be an important one. more so than the ISM. The ISMs I don't really care about. They don't seem to have much persistence other than the moment they're out. No one really pays attention to manufacturing anymore. It's all about services. I think this is the king of the show. And then jobs and CPI really is more about the Fed at this point. This is a report card on how the fiscal is doing. I don't think it's doing that well. Let's look at Fed funds futures. Q3 28 basis points, Q4 pricing at 37. We're at 66 as opposed to 50. We're now at 2.5 cuts. The SEP had 2 cuts. We're at 2.5. We're ahead of the SEP on this. Q1 another 25, so there's 91 basis points. This is by the end of Q1 you've had 6 meetings. I'm rounding this up to 100, saying 4 cuts in 6 meetings. That's starting to look a little bit more realistic. If you go out to next October, the market is pricing in 5 cuts in 10 meetings. That's starting to look a little bit better. ZQ has paid off very, very well. I had 42 contracts. I've lowered it now down to 32, so I'm still long on ZQ. I'm not ready to close it altogether. I think there's going to be more than 2 cuts for this year. I've always held that, for a while I've held that view. They've got more than enough permission to cut. More than enough permission. I had also put a prediction in that Trump would more likely than not announce a replacement for Powell before July 4th. Well, that conversation has really lit up, hasn't it? Although I don't think he's going to announce a replacement for Powell by Thursday. It's going to be an apprentice-style showdown among those who show up. It seems that Bessent probably would be the one that would do what Trump wants sooner. And I think the strategy, personally, I think the strategy will be to put somebody in place, because you can't just put a dove in place and say, go ahead. You got a committee. You got to get a consensus builder in there. I think Bessent could probably get that done, probably the best for consensus. You got to get them all on board to agree. Cut the short rate. You start saving money right away. Cut the short rate. The Treasury should move all of its issuance into, or as much of its issuance into money markets as it possibly can, into 3-month T-bills, 6-month T-bills, and issue heavily on that end and create a supply shortage on the 10, the 20, and the 30. Maybe not so much on the 10, but the 20 and the 30. The trade deficit, I think, only gets worse, so that's more U.S. dollars that has to find a home. Issue less of the 20 and the 30. That will start to lower the yields. Take that $2 trillion in mortgage-backed securities, sell that off, and move that into the 10, 20, and 30 and lower that part. In fact, you could just move it all into the 10. You'll start to lower mortgage rates. If the 5-year starts coming down as well, which it should, you'll start to lower car loan rates, and you'll start to lower the long-term yields as well. I see that as the natural unfolding. I mean, I look at it and I think, well, what would I do? I would want to hire somebody that can get everybody together, that everybody has some respect for, that says, okay, yeah, we'll go your direction. And this to me seems like a great pathway, because you have mortgage-backed securities you don't want, right? Sell them. Buy the 10-year for $2 trillion. You haven't changed the size of your balance sheet, but you have affected rates. Lower that short rate. So I think 127 in 10. When does the new Fed chair take effect? Next May of 26. This is as of October of 26. This is where I would, any pullback on this, any pricing out of rate cuts, I would probably say I'd concentrate most of my purchasing of the Fed funds futures for October. Not much to see on this screen. Let's go over to the OAS first. Almost nothing happening over here. You had high yield. That's quite a bit, 12 points, pulled back 3.8%. The spreads contract, and on triple C, contracting 2%. Nothing to see here. Again, been saying that for how many years? Nothing to see here. Real yields coming in. across all the tenors, and inflation expectations coming down across all the tenors, all in the right direction. Nothing to see here. And mortgage rates, look at that. We're printing 6.7 now. We were 6.8 for such a long time. 6.7 down 4 basis points. So if this trend continues, we can see the 10-year continuing to fall. We can see the 10-year real rate continue to fall, and mortgage rates continue to fall. Housing starting to pick up. I think it's a little too early to jump back into housing. I think if you see this sustained for a period of time, let's wait till July. If you start to get a cut in July, you'll start to get a lot more activity in the housing market, except kind of late in the summer. And I think sometime this fall, by the time you get into October, November, that would probably be the time that I would think that it would be a good time to get back into housing. Let's take some time with student loans. I'm sure you've been hearing a lot about this, just the sheer number of borrowers that are in delinquency. I don't think it's a big deal. I don't see this as having any contagion effect at all. So I looked into it and I thought, I'm not really that concerned about it. The numbers are ugly. There's no doubt about it. But the government already has lent the money. So worst case scenario, they don't get paid back. So if they don't get paid back because there's default, the taxpayer is already paying for it anyways. The taxpayer already agreed to pay for it. Look at this, 1.7 trillion outstanding. Number used to be higher, but under Biden there was a lot of debt forgiveness. So it's 1.7 trillion outstanding. These numbers are crazy. As of April 2025, 31% was 90 days plus past due. That's not 31% of the total. It's 31% of borrowers were 90 days past due. Now, this 31% just could be a lower amount, representing a lower amount of money. Most of the ones that are past due never finished their program. So they went a year, they went 2 years, they said, this is not for me. They didn't get the value out of it, but now they owe the money for it. And in their mind, it's probably easier to say, I'm not paying for that. It'll get forgiven. The government will let it go. I won't have to pay it. They're probably holding out and waiting. Why should I pay $1 if in 6 months they're just going to forgive all this stuff, right? So part of the delinquency could be the training of the borrowers to expect the government to bail them out, because the Democratic administration really wanted to do that. So if I think it's going to be paid off for me, why would I pay any of it off myself? Why not direct my money somewhere else? And if it's going to be paid off, it doesn't affect me. This is the highest ever recorded. Payments resumed in early 2025. Here is some status here. 90 days delinquent, number of borrowers, 5.8 million borrowers. You must be delinquent for 270 days. No payment for 270 days to be what's called in default. So this is just delinquency here. This is default. There's already 5 million borrowers in default. 5.8 million, 6 months or less. Of that 5.8, 1.8 will enter into default in July. They're just weeks away from being in default, but they weren't paying anyways. So when July comes, all you're really doing is changing the label. Okay, you're not delinquent. We'll take you out of this column. We'll put you in this column called default. In August, another 1 million will enter default from this 5.8, and in September, another 2 million of this 5.8 will enter default. But they're not making payments anyways. Federal loans are 92% of all student debt. So how it works is, you want to go to school. It's going to cost you over the 4 years $100,000. You get a loan. The federal government then sells $100,000 in bonds. And let's say that it sells these bonds at 4.5%. In the year that you borrow the money, you have a set interest rate. That might be 6.5%. And then you are expected to pay back. So this $100,000 in debt is really your $100,000 in debt. It's just that the government has a better cost of capital than you do. So it extends that cost of capital to you plus a spread. So of the $37 trillion in debt, 1.7 is owed by students. So it's really only 35.3 trillion, because the 1.7 is owed by all these students. But if they don't pay, well then, yeah, then the taxpayer is on the hook for the 37 trillion, not the 35.3 trillion. But they're not paying. They're already not paying. So it's not as if next month in July, when this 1.8 million changed their title from delinquent to default, that there's going to be this big change in cash flows going around. They're not paying anyways. So I don't see this as a big deal, because federal loans are 92% of all student debt, and that money has already been borrowed, and it's already part of the national debt. No money is flowing in from these people to pay that money back anyways, so what's the worst case scenario? In fact, this is probably a better position to be in, because now you can actually seize assets, you can garnish wages. I think the two things they can do is seize your tax return and garnish your wages. Wherever you're working, they can put a garnishment on your wages. So if anything, if you enter default, it actually starts the cash flow flowing. I've heard a number of people now say, oh, we're not paying enough attention to these student loans. This is a big deal. And I think, it's a big deal if this were all private. Then you have to have the government step in and bail them out. But the government has pre-bailed them out already by issuing the debt themselves. So if the government bailed them out, they've already done it. Worst case scenario, the government just doesn't get money. But what are they doing? They're not getting money now. Am I missing something here? I don't see this as a problem. They've already borrowed the money to give to the students, and they're already not getting the money back. What would change? Of all the people paying, only 38% are current. 31% are delinquent, which means you have another 31% that is somewhere between current and delinquent. You got to be at least 90 days late or missing payments to be delinquent, and 270 to be in default. So somebody might be 48 days late. Well, that means they're not current, and they're not delinquent. They're non-current. I have to ask, how much of this is the expectation that the administration is going to say, okay, you don't have to pay this back anymore? Wrong administration to be expecting that. And I don't know where I would be if somebody said, well, what do you think? On the one hand, you did take the loan. You did sign the papers. You were going to school. You are getting a private asset. The education belongs to you. I cannot repossess that education like I can a house or a car. You get to walk away with that asset. So why should you have the ability to walk away from the loan if you never have to give up the asset? Now, that asset will accrue to your private benefit. But if the loan is forgiven, you're asking all the taxpayers to pay for a private asset that you get to own the rest of your life. You see where I'm going with that? It's your private asset. Now, if it was a situation of, well, we'll give loan forgiveness. However, if you make more than 1.4 times the national average, 100% of that goes to loan repayment. It's not a tax, it goes to loan repayment. So that the private gains of that education don't accrue to you 100%. Okay, so you can't make your payment today. If the only job you can get is at the national average, okay, we'll let you go. But if the benefits from that private asset do start to accrue to you, hey, the taxpayer owns that part of the equity. Do what businesses do. The company, it goes into bankruptcy, the equity holders are wiped out, the debt holders become the new equity holders. Give me equity in your life. I get, the taxpayer gets everything above 1.4 times the national income. They did buy that asset for you. That's one side of the argument. The other side is, well, if you move to another country's model and you made education free. By the way, that old saying, right? If you want to know how expensive something can be, make it free. I think if you made education free in the U.S., it would be almost unaffordable for the taxpayer. But let's say that there's enough people who say, well, education should be free, which means these people never should have paid for it anyways. The government and the taxpayer would have been paying for it. This is the situation we're in right now. If you forgive all the student loans, is that it was free. I don't know. I'm more on the side, but I'm not 100% of no forgiveness. I am far more than 50% on the no forgiveness, again, because the asset, the gains to that asset will be privatized, but the cost of that asset will be socialized. I disagree with that. Let's give another hit to education. You have very high new graduate unemployment rates. You have student debt that seems to be crushing at least some people. If we take it on the benefit of they can't pay for it, if we take it on the benefit of they're unwilling to pay for it because they've been trained to believe they won't have to pay for it, that's a different story. But look at this. This is not helping. I've been critical of education for a while. The 4-year university degree, I think, is anachronistic. It's a business model of the past. Honestly, there's 30% of a 4-year degree, 30% of the courses you take that are useless for what you're doing. I think you could, so 30% of 4 years, that's 1.2 years, you're down to 2.8 years. Of all the courses you do take, I think there's a good 30 to 40% in those courses that are also useless as well. I really do believe you can get a 4-year degree done in 2 years. But kind of hard to justify the 2 years and the tuition payment if you can do it for 4. So it gets brought out to 4, but much of it is useless. Look at this. The CEO of Standard Chartered admits that his MBA was a waste of time, and that the skills he learned at college have degraded over the last 40 years. Having been in the system, the university system, for some 31 years, a little over 30 years, as an undergraduate, as a teacher's assistant, as a graduate student, as a graduate assistant, as a PhD, as a research assistant, as a professor, I can tell you that a lot of what is in, and from a business school perspective, a lot that what's in that 4-year degree is a useless waste of time. I look back at my undergrad, even my MBA, and I think 50, 60, 70% of that stuff I've never once used, and it's obsolete. Much of it is just simply obsolete. Any marketing course you took 10 years ago is obsolete today. Any marketing course you're taking today is obsolete in a year, right? So unless it's practical application, it's obsolete. If you're learning marketing from a textbook, you're already wasting all of your time. Much of the course, I think a couple of the courses were really valuable. Accounting, finance, economics, business law, very useful. Organizational behavior, organizational theory, HR, absolute waste of time. I agree with him on this. Most of his skills have degraded over the last 40 years. He says that soft skills like communication, curiosity, empathy are more important as AI takes over grunt technical work. I agree with that as well. A LinkedIn careers exec agrees that human touch is the new in-demand talent capability, and you don't need a degree for that, right? Instead, human soft skills like curiosity, communication, and critical thinking. If you have the applied analysis, I am giving you a heavy dose of that as it relates to develop your critical thinking skill, as it relates to developing your AI skills as well, are incredibly important in leadership and work, according to the 63-year-old CE. And those are skills that don't require a college degree to pick up. The education model is under attack from a number of directions. From an ideological direction with the administration, and I do agree with some of the things they're doing, that universities like to say they are a place of diversity, except diversity of thought. Having been in the system, I can tell you that's a thing. Is you lean left, right? Even in a business school, you lean left. Much of what you take, I think, is useless. You You can do it in less than 4 years. This is a colossal waste of time and money for both the professors and the students. A business degree is a professional degree. However, business schools tend to overwhelmingly hire academic researchers for a professional degree. So I'm going to agree with this guy again that, if you're going to a school where the professors are well-published academics teaching a professional degree, probably going to have 50-60% of the content of that course absolutely useless. Now, I want to contrast something. The CFA is non-academic. It is practical. It is as practical as you're going to get. And even though it's gotten more and more expensive, if we say, okay, well, it's $1,500 a level, roughly, right? $1,500 a level. There are 3 levels. That's still only $4,500. And this is equivalent to, I'd say, 90% of the business schools that offer an MBA or a master's in finance, not the research side, but just a general master's in finance. It's equivalent to that, and this is recognized because there is only one CFA. So even though they have been raising their prices, if you think about the business model of an undergrad followed by a master's, this is far superior. Far superior in terms of its connection with the real world, especially when you get to level 3. It is far more connected with the types of decisions that you would be making in the real world. What is lacking from here, though, that you're supposed to get in your undergrad is the development of critical thinking skills. But oftentimes that just gets bypassed. At least that I've seen that is when I did my undergrad. There was no actual training in critical thinking. It was just expected that you'll pick it up as you go along. You'll figure it out when you get there. You'll either have it or you won't. Well, would it be nice to see what it looks like? So I think models like this, what the CFA is doing, I think you're going to see more models like that. That rather than all of this filler to get you ready for your accounting designation, I think you're going to see probably hopefully schools change. That you don't need to sit through 4 years. There are these courses that you need. Let's give you these courses. And enough of the academic researchers teaching in a professional school. If it's a professional designation, get professionals in there teaching it. It is a broken business model. Okay, on Friday, we had a bit of a market downturn, which made sense. And then we had the total willingness of the market to say, we don't care, we don't care, we don't care, on top of everything. We're looking past this. Haven't you heard 2026 is going to be a wonderful year? This came out at 144. I'm going to show you something on this chart over here. I said before that I suspect they're trading against, that they know what they're going to do and they're trading against the market. I suspect it. I'm going to show you this in a second. Let's just read his truth, because it is Truth Social. Don't call it a tweet. That's X. Actually, can you still call it a tweet if it's X, or are you Xing out? Well, this is a truth. We have just been informed that Canada, a very difficult country to trade with, trade all caps, so you got to yell it, to trade with, including the fact that they have charged our farmers as much as 400% tariffs for years. That is not a fact, and that is not true. On dairy products, it's just announced they're putting a digital services tax on our American technology companies. We didn't just announce it. That's been out there for a while, which is a direct and blatant attack on our country. A direct and blatant attack. They are obviously copying the European Union, which has done the same thing. That is not true either. Some countries in the European Union have, but not the European Union. And is currently under discussion with us also. Based on this egregious tax, we are hereby terminating all discussions on trade with Canada, effective immediately. We will let Canada know the tariff that they will be paying to do business with the United States of America within the next 7-day period. Always some time, just in case there's a, air quotes here, deal that he can announce. Thank you for your attention to this matter. So it is true. The tax rate is 3% on digital services revenue over 20 million. So if you are generating more than 20 million in revenue in Canada, you would be charged 3% if you are doing more than 750 million euro in global revenue and 20 million in Canadian digital revenue. This is just digital revenue, right? This I don't agree with, this retroactive start date going all the way back to January 1st, 2022. I don't like that. How was it possible for a company in 2022 to plan? If you know, it would be like saying, listen, I'm going to raise your tax rates from 40% to 50% retroactive for the last 5 years. It'd be like, whoa, whoa, whoa. If I would have known, I could have engaged in some different types of investments. You can't do that. So I think the White House has a point on this one. This retroactive business, I don't know. Now, it could be just a negotiating tactic, because that's what good negotiators do. When good negotiators come to a situation, they will quickly assess what the other side wants. So there's the U.S., and they will assess what the other side wants. And they will find a way to give the other side what it wants if it can. Right? That if I can give you what you want, then you give me something I want. So I'm going to figure out, what is it I can give you that's okay with me? You want this? I think, I'm okay with that. I'm not going to tell you I'm okay with it because you want it. I'm going to want you to give up something for me to give you that, but I'm okay with that. And then you throw on some things, you know, if the U.S. is good at negotiating, they'll throw on some things they don't really want. Things that cost Canada money, but things that don't give them any benefit at all. There's zero benefit. These are things that you want to trade off on. So what do? You know the U.S. doesn't like the digital services tax, but you want the digital services tax. You put a digital service tax on and you make it retroactive to 2022. He's giving us 7 days so we can go back and say, well, you know what? Yeah, okay, let's get rid of that up to 2022. Let's make it as of the date that we announce it going forward. You see what I mean? You put in a bunch of things you don't want, that you are perfectly willing to give up, but you know that it's going to cost the other side and it's going to be a problem for the other side. So you're willing to give it up, thereby giving them a win, but it doesn't cost you anything. So this retroactive start date to January 1st, 2022, if I had to bet, I think that would probably be the thing that goes, but the digital service tax stays. Because you look at this, you say, but why retroactively? That doesn't, I mean, you got to cry foul on that. If they did that to you on your personal tax rate, you'd be screaming, saying, whoa, 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 you can't do that. So I think this is part of negotiation. First payment due June 30th, 2025, covers 2022 to 2024. If the first payment is due June 30th, maybe they'll announce something on Monday to give Trump a victory. Give him a V. Hey, look at this. We got rid of that thing, but what happens in the end is we get exactly what they wanted, which is the digital services tax, which is exactly what they didn't want. Right? How bad is it? Canada 3%, France 3%, UK 2%, Italy 3%, Spain 3%, Turkey 7.5%, Austria 5%, Belgium 3%, Hungary 7.5%. If they're that upset about Canada, their closest trading partner, where they do significant trade, to say that all deals are off, all talks are off because of this expect retaliatory reciprocal tariffs to hit these countries. Now, some of the retroactive dates on these for some of these countries were all the way back to 2019. So maybe the 2022 isn't that unrealistic. I just would cry foul if you did it to me. Penalties for non-compliance, $20,000 a year. That's nothing. Right? If it was only $20,000 a year, I as Google would say, here's your 20 grand, get lost. But it's more, right? 5% plus 1% per month for late payment filing, so that's up to 17% interest along with 20,000 a year is nothing really. So we should be prepared for something on July 9th. We should be prepared for something on reciprocal tariffs. Look, the market is okay. The market is, as of Friday, printed an all-time high on the NASDAQ and the SPY, with everything that he's done, with the bombing of Iran, with the 10% tariffs, the 50% steel and aluminum, the 25% on cars, the canceling of the Canadian talks altogether, the 35 or 40% on China, and the market is at all-time highs. He has permission to do more, because he'll look at it saying, look, the market loves what I'm doing. They love what I'm doing, and I can claim victory that the market is here. After everything I've done, I can do more. You called him a chicken. So I think the taco trade is dead. The taco king is dead. Long live the ego king. I think you have to switch to the ego trade. He is not a chicken, and he is damn well going to prove to you he's not a chicken. You did it to yourselves. Now, one of the things I think that are hurting Trump is his ego. It's the very thing that I think that we need to switch to as an ego trade, is the very thing that's hurting him. If he were a poker player, I think an intermediate player could wipe him out easily because he has a tell. He announces how good he is as a deal maker, the art of the deal. Everyone keeps touting him as this big deal maker, well, at least people in his own party. So he's got to announce deals, and he loves announcing these deals. He doesn't care if it's a good deal, only that it's a deal. Well, if I were negotiating against him, I'd think, on the list of things that you want, I wouldn't be putting, well, dairy, this. I'd be putting ego top and center. Well, we know what he wants, ego. You tell him he's a great person, and you give him a victory, any kind of victory, and you'll get anything you want. You can negotiate almost anything you want. But I know that he wants to announce something, so if here is the deadline, I'm not going to give him a victory here, because he wants this. Above all else, he wants this. I'll wait. This is not going away. I'll wait, and I will get all the concessions I want as long as I give him his ego. I think that is underappreciated right now. At least in my model, that's what I see. I expect that there will be reciprocal tariffs. I expect that he will carry through with them this time because you called him a chicken. I think countries that tell him how wonderful he is, that he's right about everything, and they're going to do as much as they can, will get a pass. That's all you need. I think most countries will probably use the 18-month rule at this point and say, look, he's more than likely going to lose Congress in 18 months, so why do a damn thing now? Now, this is interesting. If you are watching the price action on Friday, these bars aren't really long enough, short enough in a time frame to show it. But the action of the day was like this, and whenever there was a pullback, you had this movement, and then there was a pullback. It never actually got. The action of the day was just strong and upwards. And then it did this. If you had listened to my positions video earlier that day, I had said that between 3:30 and 4, I was going to get rid of my short beta position and take off some of the corresponding long beta position, because I am short SPY, long IWM. I do have a net positive beta position. I was going to reduce it just to net positive because the market just doesn't care about anything. It has a narrative in its head that we're going on to new highs, and everyone thinks we're going on to new highs. Nobody I know believes it. But everybody that I talk to says, yeah, we're probably going to new highs. It's not justified by the fundamentals, but here we go. It's a psychological market we're in, and you got to play it that way. This over here, up to this point in time, was out of character with the rest of the day. So when I saw it happening, I thought, is this sanity? Are we finally coming to, are some people out there saying, okay, now's a good time to hit profits? We're at 616, 617 on SPY. Now's a good time to take profits because we are out in terms of valuation way over our skis. With the level of uncertainty we have, we shouldn't be here. Maybe this is what's going on. And then this is 144 right there. That is when this hit. Is when this announcement hit. So I look at this before and I say, somebody must have known, because it was out of character with the day. Only if you had the chart up and you were looking at the chart, you were looking at the volume weighted average price because you were looking to do some trades around that price, would you have picked up on that? If you were watching it and you saw it drop and drop and drop, first thing I did was, let's look at the headlines. Nothing, no news anywhere. It wasn't until it was further down that the news hit, and then this is what you got. So somebody had to know something. And that somebody is the president. I do think he's taking this opportunity to trade. Not directly himself, but, you know, gets the news that Canada is doing this, says, okay, give me half an hour. I'll give you my decision. And makes a phone call on his burner phone and says, okay, short the market. Here's what I'm going to do. And perhaps this is not the market saying we don't care. Perhaps this is, okay, that was good money. Go ahead and cover. And then the market drifted off after 4 o'clock. I have no evidence of this. It's just when you see this kind of action before a significant announcement, you can always conclude that somebody knew something somewhere. Look at, we refer to this as Merger Monday. Usually big mergers are announced Monday. Look at the history. Go back over time and look at all those mergers that were announced and look at the price action the week before. The price action was strong, and even into Friday close, all of them have this kind of thing. Why? Because so many people know about it. There's so many people involved that know somebody else, that knows their cousin who does this and does that. You do this and we'll share the product. That goes on. This is insider trading that goes on. That goes on. This had the same fingerprint. Because again, I was looking to close my position, and I was going to use some kind of pullback to start doing it below the volume weighted average price. So when it got a little bit high, what I was doing as it was above the line, a volume weighted average price, by the way, is just a line that follows, that you can follow where it's weighted by the number of shares. So you get a weighted average price. When it gets too far above the line, you start unwinding some of your long position. When it gets below the line, you start unwinding some of your short position so you can get that gain in there. Well, it started doing this. Only if you were really watching it, you would have thought, that's really out of character with the rest of the day. Something's going on. Let's look for news. And there it was. Who knew? Who knew, and how much did they know, and when did they know it? Right? This is, what will we call this, S&P 500 gate? Somebody knows something somewhere, but Trump owns the SEC. Trump owns the Department of Justice. There will be no one looking into that. Okay, S&P all-time high close on Friday, 614.91. It drifted down to 613.43 after hours, but 612 was the last previous high. So even with that, we're at all-time highs. Bomber ran, well, there's that big green bar. Next day, let's go even higher. Next day, let's go even higher. Next day, let's go even higher. Friday, let's go even higher. Oh, no, Canada, who cares? Let's go. It was just the narrative all week long was we're going higher. Why? Because we're going higher. Why? Because we're going higher. That was the story. We're going higher because we're going higher. So we are back basically at 23 times forward earnings. Last week we ended at 22, so we added 0.8 of a multiple on this week on economic data that really didn't support it. That probably supported something lower, but no, we went the other way. Certainly wasn't operating earnings. They haven't budged. 269.60, 61.73. So yeah, that's the price of the market, and nothing to fear. All-time highs and nothing to fear. If we look at February 19th, the last time we hit an all-time high, implied volatility was 11.15. Here we are June 27th at 13.14. The typical relationship is the higher the uncertainty, the more of the premium you need priced in, which means a lower price. Not so much in terms of the dollar amount, but in terms of some valuation metric. But nope. We are perfectly willing to pay the same price, the same valuation at higher uncertainty than we had at lower uncertainty, because haven't you heard? 2026 is going to be a wonderful year. Small caps not really coming along, right? But certainly well off their lows. 215.48 on IWM, down 11% off its all-time high. IJR down 13 from its all-time high, and Triple Q's 548, another all-time high on these. I did hear an argument during the week that on Bloomberg from an asset manager, an older asset manager, probably older than me. I'm 58. I think they might have been in their 60s or 70s. They put an argument out there saying, look, about 50% of the S&P 500 have asset-light business models with strong cash flow. So we think that supports a 22 times forward PE. So we think the market's going to go up from here, was their answer. I can tear this apart so easily. I mean, I heard it. I thought, oh, you can't be serious. Who are you saying this for? Are you saying it because you want everyone else to be long because you're long? Because none of this is true. If you think 22 times forward earnings is justified, when you said it, we were over 22 times. So why would the market go higher if you think 22 is the fair value? You didn't say anything about operating earnings going forward. 50% of S&P 500 asset light, that is simply not true. That's not 251 of the companies being asset light. Where? In utilities? In materials? I mean, go through the sectors, go through each of the sectors. That's not true. Only in communications, that's not true. Maybe Facebook. Only when you get to the tech sector would you get there, but that's not 50% of the company. So maybe he meant 50% of the weight. And it's not even 50% of the weight, it's more around 30% of the weight you would call asset light, but only if you follow accounting practices. If you say they're asset light, you cannot say they have strong cash flow. You have to go to free cash flow because you have to look at CapEx, right? These companies are investing tens of billions of dollars into their AI strategies. Well, that's internally developed IP, which is written off. That's not an asset, but if you had to put it on the balance sheet, they would be asset heavy, not asset light. And since it's being charged to income, you can't look at at cash flow. You have to look at free cash flow, and these investments are eating up a lot of that free cash flow. So none of this were right. The premises were false. The conclusion is invalid. When I heard the person say it, I thought, okay, well, it sounds good. Yeah, okay, it sounds good, except it's not true. None of it is true. Look at this. We got agreement. Ta-da! I mean, it's got to start somewhere, right? LSEG, sectorspider.com. One company's reporting earnings. They both agree it's this company, and they both agree it's on Tuesday. Okay. You take the victories where you can. Let me explain what I'm doing with my position. I am short SPY, and I am long IWM. In such a way that I'm still net positive beta. I am short here primarily because of the overvaluation and because of this administration. This administration, when it comes to execution, is a shit show. I don't expect that to change. You still have a king, and on Friday he showed that he's still a king. You have July 9th coming up. That's just not going to pass. There are going to be countries that are going to get reciprocal tariffs. Why? Because of everything he's done, the market is at all-time highs. It's not that the market is looking past him in his mind. It's that the market loves him. Look at where it is. I did this. The market loves what I'm doing. Let me do even more for the market. If we look at IWM's valuation, it is a much better valuation than SPY. So I'd rather be long IWM than SPY. I see these massive investments in these AI facilities being future impairment charges. The revenue is simply not going to be there. I got a screen coming up where I'm going to show you this, or at least show you as much information as I can have. I've laid out the value chain before, and I think the suppliers, like the chip sellers, the data centers, the energy providers are going to be the winners, and I think consumers are going to be the big winners, but I think everyone else loses. AI is going to make small cap companies far more profitable because one of the big problems that holds them back is the access to talent. Is they simply can't attract the same type of people that the large companies can, and they're always constrained and probably with less favorable cash flow, more constraint both financially and strategically with the people that they can bring on. AI will increase their productivity, that dollar for dollar, percentage wise. I think there's a lot more potential in AI, the intersection set of AI with small caps and AI with large caps. So, to get to the point, as of Friday morning, I had decided that, you know what, this market, it's not going to respond to fundamentals. The fundamentals are falling where I want them to. It is leaning towards a direction I want, but the market is not looking forward. Because here's the timeline, and you have to look forward at the effect of what these things are going to do. And here we are with fundamentals that don't support this price. Well, the market is looking past all of that to some fantasy of 2026 being a fantastic year. The future is unknowable, but there are certain things, certain trajectories that we can see that are already in place that we know will happen. But if you look past it, you look past all of this stuff, and I think that's what's going on. I think I'll eventually be right, much like everyone was eventually right in 1999, but you got crushed in the meantime. And this feels like 1999, except everywhere you hear AI, change it to .com, and that's exactly what you had during that year. Even consumers, everybody was talking about, have you seen this site? Have you gone to that site? Everybody had a new site. There was a new one popping up. There were search engines everywhere. Ask Jeeves, Yahoo, they were everywhere. Much like there are these foundational AI models everywhere. There's a whole bunch that you could use. Nobody had any allegiance to any one in particular. But consumers were just enthralled with this thing called the internet, because you had the Netscape browser at that time. You had a graphical user interface. It became easier to use, much like the AI tools today are becoming easier to use. It's not this big process where you have to install something first and use line item codes to get what you want. It's this text-based user interface, much like a Google search, where you type in what you want and you get it. So acceptance has really exploded on this thing, and it feels like 1999. I think NVIDIA will probably end up going the way of Cisco. I think most of these AI startups will end up going the way of the .coms. And I think most of these foundational models will end up going the way of most of those search models, with one of them being dominant. In the end, it was Google. But Google was late to the game. You had a whole bunch of search engines, and then Google had a better one. And you have a whole bunch of these foundational models right now that are built on language models. Even the reasoning models just break a prompt down into a whole bunch of logical steps or thinking steps, and then each of these steps hit the language model. These are your foundational models. You're building your specialized models off of these. Think of these as all of the different search engines, and in a couple of years, there is good data out there suggesting that this is suffering from diminishing returns right now. You're going to need a new technology that can go beyond and past that. There'll be another Google-type search engine, a Google-type AI, I'm not saying it will be Google, that will make all these LLMs go the way of Ask Jeeves and Yahoo Search and all of those. So yeah, I was going to close this down on Friday. I was waiting till the end of the day, 3:30 to 4, to really shut everything down. That if we were hitting new highs going into the close, to me that was a clear sign that that's it. The story's done. Given the sell-off that we had, given the news, I didn't do anything. I shouldn't say I didn't do anything. I did sell some IWM. I pared down some IWM. I took those gains and I took the appropriate SPY losses on these. I'd also sold 75 puts at the 209. Sorry, not 209, 609. I sold 75 puts at 609 on SPY to generate some gains there to offset some losses. So I started sketching out some notes. And I thought, well, I'll transfer these notes to the screen and share them with you. This is sort of how I help organize my thoughts. I have just a simple value chain at the top over here. The GPUs, get a bunch of GPUs, put them in a data center, combine some energy, and build a model. And your model builders are things like OpenAI, Anthropic, Google, XAI, etc. All of these are losing billions on this. Their cash burn rate, XAI had reported they're burning about $1 billion a month. All of them are losing money. OpenAI publicly said in the most recent few months that they're losing more money than they thought, which is good because more people are using it than we thought. They liken it to acceptance. This is the same language we had in 1999, because it was about eyeballs. We'll figure out the monetization strategy after, but right now it's about eyeballs. And we're losing this much money. Here's our cash burn rate, but it's because our eyeball rate is going up. So one of the metrics they had is how many active users they had. And they called it, how many eyeballs we have looking at our site. And we'll figure out how to monetize it later. Same language going on. You have the users of the models. They can be business or they can be employed consumers. I say employed consumers because this is going to matter going forward. I think these are the clear winners and these are the clear winners, sort of a barbell strategy. And I would just avoid the middle part of it. And how I'm playing this is copper. Because data centers, you're going to need copper. Energy production, you're going to need energy transmission. You're going to need copper. So this sort of encapsulates everything. This is the core input to everything you're doing on that end. Be long copper. And I think the consumer is the winner. I don't see the model builders as being winners here at all. I see them being massive losers, and I see businesses either getting nothing out of it or being losers altogether. Let's start with why I think the model builders are all going to be big losers. Massive competition. I'm going to show you on the next screen just the sheer amount of companies that are competing in this space right now. Imagine you had 15 different Googles that you could choose from, all doing about the same job, right? And you could pay for it or you could use the free version. Which one would you pay for? And they're all doing about the same thing. And if this one says, well, you got to pay for it, well, this one over here is free. And if you're saying, well, you can only have 20 searches a day. Yeah, but if there's 15 that are offering me 20 searches a day for free, don't I really have 300 searches a day for free? So if I'm on the free side and I run out of AI searches on Anthropic, I'll switch over to OpenAI. And if I run out of free there, I'll switch over to Gemini. And if I run out of free there, I'll switch over to Manus. And I'll just keep doing that. I'll just keep hopping from free to free. It's hard to get money out. Massive competition. There is a default first behavior among consumers. Default first means consumers tend to use the first tool that they start using. So having a first mover advantage matters. OpenAI has like 800 million active users, but only because they were first out there. The model from Gemini or Anthropic would have to be so much better to convince them to switch. They sort of just sit where they show up. Very capital intensive. This is not free to do. It's super capital intensive. The conversion rate from eyeball to cash is about 3%. Guess what it was in the .com area? Pretty much around that level, 3 to 5% conversion from eyeballs to cash flow, and it wasn't enough to support all of those .coms. And you have diminishing gains in the technology. The revenue, the most recent number for revenue is 12.1 billion for the whole industry from everywhere. General models, 9.8 billion. General models are what you're getting from these guys over here. And then you have specialized models. There's a whole bunch of different specialized models in terms of images, in terms of audio, in terms of video that you can get. 2.3 billion. OpenAI generates 86% of this 12.1 billion. 10 billion in revenue so far, 800 million users. If there are so many models, how do you charge for them? Like I said, if you have a free side and a paid side, and I run out of the tokens I get on the free side, can't I just jump to the next model that gives me free and the next model that gives me free and so on? If you can't cover your costs for them, you have to follow the Google search the YouTube, the Gmail model and get somebody else to pay for it. This is the Facebook model as well. Facebook is free. In exchange, we need a little bit of information about you, and we're going to sell that to advertisers so that you can get this product for free. We're going to get somebody else to pay. So you can sell ads, affiliate revenue, or marketplace models. This is dangerous because the ads end up showing up in a way such that it generates affiliate revenue. So let's say you ask the model, in the luxury SUV space, give me the top 4 rated models and their total cost of ownership. Well, if let's say Range Rover had decided that it wanted to pay to sell that, Range Rover would be number 1, and it would pay to be in your AI search. It would be number 1, and every time you clicked on something, or if you followed through on something, there might be some affiliate revenue going back to the model to put it there. You see this in newspapers where you're reading a story and you find out very quickly that the story is not a story, it's an advertisement, it's an advertorial. And it's meant to give the impression that it's a serious story that promotes a particular product or business. Well, what if you start having that in your AI searches? That kind of ruins it, doesn't it? You got to get somebody to pay for this stuff. So I would look to probably ads first. I think OpenAI was suggesting that maybe they could sell ads. So for all of these companies here, now Apple doesn't have one. Apple doesn't have a foundational model. Of all the companies, you would think that they would have one. They don't have one. Having a foundational model will be more about keeping market share than about expanding market share. So it becomes a competitive necessity, not an advantage. And that necessity costs billions of dollars, and there's too many of them. There are too many of them to all make money, and they're all around the same place. And it's not as if you're on this trajectory where some will do this and others will fall out here, but one will continue on. They're all on an S-curve trajectory, all of them, because they're all using the same architecture, the transformer architecture. It has diminishing returns, already seeing that. So no, I don't see that this cost is going to be justified with a 3% conversion rate with this many people doing it, where I have free options all over the place. Where's my motivation to pay? All right. Let's look at businesses. Yeah, we can use AI for higher productivity. We can lower our costs or get higher output. So with the same amount of staff, we can increase our output, or we can keep our output constant if we're in a particular market that doesn't absorb higher output. We can keep our output constant and just lower our head count, right? Excellent. But every business can do this. If I can do it, you can do it, because these tools are widely available. So it's not as if I have some moat, some competitive advantage because I can use these models to do something. If I can use the models to write a bunch of low-level code, so can you. So can they, so can everybody in my industry. So now it is a necessity, not an advantage. And when it is a necessity, any advantage is quickly priced out, which means it's just another layer of cost. If everyone can do what you can do, and you are competing in the same market, you get lower prices but not higher margins. That's why I say the consumer wins. I can do a lot in the teaching space at lower cognitive domains with AI. That means so can everybody. Anybody who understands learning theory can do the same thing. That means you have some professor in some finance department somewhere saying, I would teach CFA, but I don't have the time, can now do it. The amount of product that is going to hit the market over the next couple of years in all of these test prep spaces is going to be overwhelming. Output is going to increase. So yeah, it can benefit me because I can do a lot, but at lower prices. So who's going to win? The consumer. Lower prices, better quality, or more choice. All of these. So your winner is over here and your winner is over here. However, I do think this is going to follow 1999. And I do see that if you look at the chart for Cisco, This is what you're going to get. I think it's just a matter of time before you see that happen to NVIDIA. You had a wiping out of a whole bunch of these .coms. And on the next page, I'm just going to give you a sampling of the type of models that are available. Most of those are going to go away because they're all in and about the same. They're all pretty much the same, but you have VC money that's rushing into this to try to put anything into the AI space that they possibly can. The ways in which this looks like 1999 are eerie. Even just the way that they're saying the same things. We're losing money, but boy, look at the number of people that are using us. Our active monthly users have increased. That was exactly what they were saying in 1999. These companies rushing to go public, losing money quarter after quarter, but always telling you, look at our active daily users. Look at how these are increasing and getting you to look at the eyeballs they were getting. Don't look at the revenues. And it all fell apart. I see the same thing happening here because it's the same thing, except it's AI, not the internet, but it's the same thing. Back then, the stories about how wonderful the future was going to be were unlimited about what this thing could do. So much hype of how it was going to destroy malls, it was going to destroy offices, it was going to destroy everything. And it didn't. What it did do is almost destroy Silicon Valley. By the time you got to 2002, 2003, 60% of Silicon Valley had vacant signs on it? It was a question of whether or not it was even going to continue to exist. It basically wiped out that whole area because mountains of money was lost. I see the same thing happening again. I think the VC industry is in for a big hollowing out. Okay, I got these charts from a report. It was called, let me just zoom over to it here. I think I got it from this guy here. The State of Consumer AI, Menlo Ventures. Several current AI models have surpassed the average IQ of humans. Most people have an average IQ of 85 to 115, which is right. It is a normal distribution. Well, let's get something I can write on the screen here. Normal distribution, roughly the average is 100. Standard deviation is 15. So 68.3% are between 85 and 115. About 98% have a score. It says below 130. It should say. So yeah, that's right. About 98% have a score below 130. 2% above that because of this is 130. 98%. Are below that. You got 2% in this tail. That is more than 2 standard deviations above the mean. With the latest version of OpenAI's O3, Anthropic's Claude 4, and Google's Gemini Flash Thinking experiment, all well above average human intelligence scores, and we now have genius level AI. Well, I don't know that passing the IQ test is the same as using it, but okay, it's a measurement. But the more important thing is just look at the sheer number of models. There is OpenAI at the top, followed by Claude over here. There is Gemini over here. We have Grok over here. You have DeepSeek over here. You have Llama over here, and you have a bunch more. It just keeps going. There is no shortage of these models. You don't need them all. If you're using one, you tend to use one. So all of these have to split this big market. And if you start charging, if Facebook starts charging, it's not going to have the daily active users that it has. And if it starts charging, then that represents an opportunity for another organization to come in and say, well, okay, we'll charge less, and then another, then another. OpenAI, this is general assistance, OpenAI, Gemini, you got just a whole listing here. And then this is just a sampling. When I say that there are thousands of models, I'm not speaking hyperbolically. There are literally thousands of models out there. Just go to Hugging Face and have a look at all the models that you can download. Literally thousands. This is just a sampling. Routine task, productivity, note-taking, communication, consumer robotics, travel, fashion, consumer advocacy, finance. Over here, creative expression. Here is image video generation. This is image and video models, creative social platforms, presentation tools, music and audio, writing support, voice, physical and mental, learning and development, connection. Just a sampling of some of the emerging models that they've given. It is nowhere near. I'd say this probably represents 1%, 2% of all the models that are out there. 1999, dot-coms were just appearing everywhere for any reason, for absolutely anything. There was a rush to stake out your space in the dot-com era, much like there is right now. If anything, this is more like early 1999 than anything else. Last year, you could say a year ago with the AI hype, it had shades of 1999, but this is pure euphoric 1999 right now. And if it follows through, there is a hell of a lot more upside in markets, mostly in the NASDAQ, but a hell of a lot more upside. Or is the market smart enough to recognize that, hey, we've seen this movie before, and it starts pricing in the realization that all of these can't win. They all can't win. That there's going to be a massive shakeout and billions of dollars will be lost, if not trillions of dollars will be lost. The NASDAQ, you can go back to 2001 and check this, lost 90% of its value from peak to trough, lost 90% of its value. The S&P 500, I think, lost about 60% over that same period of time, more than 50%. And it wasn't just a drop off a cliff. It was this slow bleed as every day another company said, we're done, we can't continue on, we're closing up shop, no value left. And it's just this slow bleed that happened over a period of 2 years. And so far, this looks like the euphoria stage right now, just in the sheer number of these things that are popping up. Now, this is not a hype technology. This is a very real technology. I use it. It is a very real technology. In 1999, I used email. It was a very real technology. I used the internet. And I said, this is not going away. Now, I couldn't see social media. I couldn't see that whole layer to the internet. This is a whole other layer of technology that's out there. This is not going away. In 20 years, it's going to be way better than it is today. But you're going to have this crowding in space at these very high rates, very expensive GPUs, very expensive data centers, very expensive to train these models, like it was in 1999, to build these sites. And then it all fell apart because the market can't handle that much competition. If it was that easy to set up, it's going to be that easy for everybody. It's easy to set up a site on the internet today. It's easy to build a model today, especially a specialized model on top of an existing model. And more are doing it because there's a ton of venture capital money that's throwing money at these companies. This is 1999. So this is, if I had to come up with a reason why the market, why NASDAQ could add 40% this year, it could add it on this alone if the market hasn't learned its lesson from 1999 or starts repeating those well-worn words, this time is different. It looks, it feels, it sounds exactly the same. You even have people saying the same things that were said back then. What do you think? You think that the market is smart enough to say, no, we've seen this before, we know how this ends, and starts pricing in how it ends? Or will it just be the hype that pushes it up? If it follows suit with 1999, forget 40%, it's 100% increase in NASDAQ. You could double it. Because all of these IPOs, and they have to be brought to IPO if they're venture backed, they're going to be rushed to market, are going to hit. They're certainly not going to be on the big board. They're certainly not going to be on the New York Stock Exchange. They'll be on this automatic quotation system on NASDAQ. I don't want to sit through that. I don't want to be short through that. I can't take the chance of that. On the one side, you have an economy that doesn't support these fundamentals, but on the other side, you have a narrative, you have a story. And I've seen this before, and it's not as if I'm making it up. You can look it up yourself. It's not as if I'm making it up. I feel the market today and I gave this analogy in my positions video, is like, the kid whose next door neighbor is their teacher, and their parents are friends with the teacher, and the kid gets A's, but the kid's not earning the A's, the kid is getting the A's, right? Well, the kid's eventually going to go on to the next teacher who is not their neighbor, and it's going to be hard to maintain these A's because these A's were not real. And I think that's where the market is right now. It's got a multiple of 23 times, but it hasn't earned that multiple. It's just getting that multiple. And at some point, it's going to have to earn that multiple. And I don't see it happening with just, if this is the story, I don't see it happening. I see this going on for a while. It's nowhere near imploding. I think we're at the early, call it first quarter of 1999 if you want to overlay some charts. We're at the first quarter of 1999, and if the market participants today are not the same market participants in 1999, they've forgotten that euphoria. These all end badly, but you can't fight this. You can't fight the narrative. So that is why I've decided that it's probably best just to pare down to a net long position and maybe grab some NASDAQ just on a whim and see where we go. And that's it.